right, welcome to the show. We got a couple people in here, so big time FUPA today. Scheduled the show for or this lunch and learn for 12 p.m., but had something come on my calendar this past weekend that I could not change, could not get out of. So it's not going to be a lot of people watching this live, but guess what? Because of the miracle of the internet, the interweb, you can go back and watch this episode, and I'll promote it some more in SME and the Stewart Media and Entertainment Network, as well as on Facebook, on YouTube as well, and all the different platforms where you see the Two Live Stews. All right, and we're going to talk about a very, I say it's a very exciting concept in investing and retirement planning. And it's called the $1 Million Baby. Okay. So I've been in this business now for almost a decade. And the first time I saw this, I was like mesmerized. I was like, oh my gosh, there's so much that you can do with life insurance, but a lot of people don't know or don't understand, or, in particular in our community, it seems like there's some stigma. There's a stigma on life insurance and retirement planning and all of that. But I'm going to tell you this. I want you to share this, the people that are watching live. And I'd like for you to share this episode with your friends and your family. And in a nutshell, the $1 Million Baby concept is a way that you can change your family's financial trajectory forever, okay, by following some very, very simple steps in doing that, okay? So what I've got is I've got a couple of slides that I'm going to show you that are going to walk you through the whole thing. And then we'll talk more in general. This shouldn't take no more than 20 minutes or so, but very, very impactful once again. So the first slide I'm going to show you, this is from an illustration. Any insurance company that you work with is going to give you an illustration of the policy that you're purchasing. It's going to give you all the details as far as how much you pay, how long you're going to pay, what the death benefit is. So if you can see this, it says policy name, whole life. I just named it whole life. Usually that's in the business. That's where we'd put the client's name. But it's giving the age of the insured. And in this case, the age is 1, because remember, we're talking about a baby. So the age is 1, and the underwriting class is a juvenile, talking about a kid's policy. Initial dividend, paid up additions, that's basically where you have the cash accumulation that continues, the buildup continues to be added to the bottom line of the policy going year in and year out, okay? Loan interest rate, 5.5%, adjustable, initial death benefit, $250,000. That's what the face value is of this policy. All right, the death benefit is $250,000, and the total initial premium is $98.96 per month. Now I'm gonna tell you why I did that. The reason I set this up for $98.96 is because in this concept, okay, let me give you a little bit more information. In this concept, the parent is buying a life insurance policy for the child, for the newborn child. The parent is the owner of the policy. The child is the insured of the policy, okay? The owner of the policy is the parent, and the child is the insured, okay? So I wanted to come up with a payment where the parent, right here, you can see $98 and I think that's 96 cents. Squinting on my end. $98.96, most people can handle without a problem at all. Okay, if you're talking about buying life insurance, most people can handle, and even when times get rocky, maybe they lose a job, they get downsized, whatever the situation may be, they don't have income coming in. Most people can still float $98 a month, okay? So the entire concept, let me give you the 1,000-foot vantage point. The entire concept is a parent buys a life insurance, a whole life insurance policy on their child. They continue to make payments on it until the child becomes an adult. then the parent transfers the policy to the child. The child is presumably out of college, and they continue to make this payment. In this example, $98.96. So figuring long term and figuring some, some ups and downs in life, and once again, getting fired or getting laid off or whatever the case may be, a child just out of college with a new job should be able to 22 years from now, when they're born, to float $100 payment per month. All right, so that's very important. That's very important that you understand. The parent pays the $100 per month until the child graduates from college. At that point, the parent transfers the policy to the child. The child continues to make payments. All right, you got that? All right, so let's go back to the illustrations. All right. What else is it showing? A waiver of premium right here. Riders included to the top right. You see waiver of premium is included in this policy as well. And what that is if you become sick or you can't work for any reason, you can't, you get sick or you get incapacitated where you can't work. The policy will be continued. The policy will continue to be paid by the insurance company. It costs a little bit more to have this waiver of disability rider on it, but for the reasons I just talked about, you can't work, you're not bringing in income, but you still want the policy to be paid. What this waiver is, it costs a little bit more, but what it does is it makes sure that the insurance company will continue to make the premium payment, okay? So the next slide on this illustration, remember, we got a 1-year-old child. We're paying about $100 per month. If you can see right here, this is year 1 of the policy. How old will the child be or the person be at the end of the year? They're going to be 2, obviously, okay? Annual net overlay or outlay. Remember, they're putting $100 a month, so around $1,200 per year is what they're putting in this. So that's $1,198. Cumulative outlay, this is how much you paid into the policy every year continually in this column right here, the third column. Okay, cumulative net outlay. And I'm not sure if y'all can see my cursor, and I don't think that you can. But in the cumulative outlay, it's showing how much you've paid accumulated each year. Okay, net cash value at the end of the year. Once again, whole life insurance. I talked about this in the first episode of the Lunch and Learn on life insurance. Insurance companies take your premiums, they pull it together with all their other thousands and thousands and thousands of clients, and they invest in the financial markets. The returns that they get, they share the returns with their clients in what they call dividends and cash accumulation. This is that line, net cash value, end of year. So this is how much is the cash value in the policy that you can take out and do with whatever you want, tax-free in most instances. That's very important. Tax-free. One of the few investments where when you pull out money from the investment, the gains in the investment, you don't pay taxes. I'm going to talk more about that in a second. And this line is net annual cash value increase. So this column, the second to the last column, is showing how much cumulatively the cash value in the policy has increased. Okay, so it's showing in year 2, it's accumulated $165 total. In year 3, it's $798, and so on and so on and so on. And then the last column, remember, the death benefit in this policy originally was $250,000. You see it right there on line 1, and that continues to grow year after year after year as well. That's the other part of it. The death benefit continues to grow as well as long as you pay into this policy. All right. When I first got into the business, my manager told me all life insurance is buying money cheap. Now, you may not be able to take advantage of this money growing. You buying this policy and for cheap, and it continues to grow. But that's really, at the end of the day, a good way to characterize it. Life insurance is buying money cheap. Okay, now keep that in mind. All right, so the next slide And all I'm doing is going through the years and showing you what the gains have been each and every year. Remember, once again, third row is cash outlay, how much you paid every year cumulatively. What we want to pay attention to is the cash value increase in the third to the last column. Once again, I'm not sure if y'all can see my cursor. And then we want to pay attention to the net death benefit in the last column as well. So the third or the fourth in the last column. Let's see, 1, 2, 3, 4, 5. So let's just say the first two columns, the year and the age in, is one column. Okay, we're combining the first two, the year and the age in. That's one column. 2, 3, 4, 5, 6. So we're looking at lines 4 and 6 are the important lines or columns to keep a track of. All right. So once again, column 4, the cash accumulation has grown. In year 25, the insured in the policy, which was the baby originally, is 26 years of age. In year 25, this policy has accumulated $41,000. Oh my gosh. Hold on one second. Okay, I'm sorry. So looking at column 4 and column 6, at year 25, the child is 26 years old. The cash accumulation is now $41,521, and the death benefit has grown from, I believe it was $250,000. Yes, $250,000, all the way to $365,751. You following me? Okay. Let's look at the next slide, just the continuing years. Okay, let's look at year 45. The child is 46 years old. He's continuing to make that $100 payment that his father or parent transferred to him when he graduated college and got his own job. He was out on his own. So the child's 46 years old right now. Look at that column 3 with the cash accumulation, once again, that you can take out when you're the owner of the policy and do with whatever you want, tax-free. It's grown from 0 to $161,610. The death benefit that originally started at $250,000 has now grown to $596,246. Okay, you follow me? Let's take a look at the continuing illustrations up in age for this child. Most people, I talked about actuaries in the first episode. What actuaries do is they basically look at data from the last 100 years or so, and based on the data and the health records and all of the things combined to figure out how long somebody's going to live, they're geniuses at it. So most life insurance policies are predicting right now people are going to live into their mid-80s. Okay? Guess what? With this $1 million baby concept of a policy that you bought when your child was born, you put in $100 per month until they became adults, graduated in college, got a job on their own. You transferred the policy to them. They continue to pay that $100 per month. And when this child is 80 years old, in the 79th year of the policy, the child's 80 years old, look what the cash value is in the policy. $1,029,330. It's highlighted in blue. And guess what? The death benefit has increased from $250,000 to $1.3 million. Now, something else keep in mind that you should keep in mind with this as well is this is based on a concept of building that cash, and you as the owner, the parent, take that cash out if you wanted to, anytime you want to. What if you're the parent and you're highly successful and you don't need to pull out that money? You don't need to pull out all this $1 million cash that is accumulated. You continue to let the money continue to build, and when you pass away, the death benefit is even higher than the cash value, because it's basically enabling, is adding into the figure the death benefit, the amount that the cash or life insurance policy was originally. Get it out, Dougie. Okay. So the cash value at the time, once again, tax-free, and I'm going to talk more about that in a second, is over $1 million. The death benefit is around $1.3 million, all from a $100 payment. Now, I know you might be saying, man, that's 80 years. But guess what? Rome wasn't built in a day. You've gone your entire life and you aren't a millionaire. Most people that are watching this right now, you know, it's kind of like one of those things where you're not going to benefit from your hard work, but your family is. You understand? And it's all at the cost of about $100 per month. Okay? So keep that in mind. Rome wasn't built in a day. You've had your personal financial situation and status, you know, your entire life, and you never figured out a way. If you're not one of the people that are in this elite category, you didn't figure out a way to become a millionaire or to leave $1 million behind for your heirs. You see what I'm saying? So this is a phenomenal thing that you can do for the legacy of your family. Let's look at the next slide. Once again, I got highlighted at the age of 90. They've had the policy for 89 years. At the age of 90, it shows how much that they've paid into the policy or that they're paying annually on the second column. This cumulative net outlay is how much you put in the policy. Think about that. When we talk about returns, you know, when you talk about returns on your money, historically, the S&P has returned right at around in any 30-year period around 9.5%. Adjusted for inflation is around 7%, a little bit over 7%. Okay? So you put in $100,000 in the premiums, you and your child, over this 90 years. Okay, you put in 104 grand, and right now you can cash out tax-free at 1.5 million. And if you don't want to cash out, maybe you're fine financially. You don't need to pull any money out in your, senior years. Okay, death benefit around $1.8 million at the age of 90. That's what we call generational wealth. That's what we call generational wealth, all from a $100 per month payment. That is the $1 million baby concept. Now, I know a couple of questions I know y'all got floating around in your head right now. You know, a lot of people aren't familiar with whole life insurance. A lot of companies don't promote it because it's not like a license to print money like term insurance is. And a lot of companies will actually badmouth it. I just went through it with you line by line through an illustration. Each time you get a life insurance policy, you'll get an illustration that's showing exactly what's going to happen in the life insurance policy. What I would suggest is that when you do business with a life insurance company, you do business with one that's got a great reputation. Like in particular, my company, and I mentioned this on the first episode, the company that I work for, I won't mention their name because when you mention names of insurance companies, they got compliance issues that they want you to, all these compliance hurdles that they want you to jump over. I'm keeping it real generic, but that's an actual illustration that I just showed you. Okay. Why would an insurance company, even though you pay the premium every month, why would an insurance company want to give you $1.8 million or your family $1.8 million when you pass away in the death benefit? Or I think it was 1.5. Why would they want to give you $1.5 million in cash accumulation, at the end of these 90 years? Why would they do that? They're not in the business to be nice to people or whatever, because remember what I told you earlier what insurance companies do with their premiums. They invested in the market and they make money off of your money. So they're okay giving you 1.5 because they probably made 10 times that in the investments that they've made with your money. Understand? So that's why a lot of people don't understand the whole process of life insurance as it pertains to you being the insured and the owner and the insurance company. Okay. So the company I work for have over $400 billion in AUM. You may have heard that term before, AUM. That's assets under management. What assets under management is, it's a cute way of saying all the insurance premiums that their clients are paying for, those are assets. Clients aren't buying insurance, and the company's taking this $100 payment in this example per month, $98 payment per month, and putting it in a savings account. They're investing it. Okay, so not just your money, the thousands and thousands and thousands and thousands of other clients that they have as well. That's assets under management. We're managing those assets. We're deciding where to put and invest those assets. Okay, so it's a very powerful thing to understand how, because really this is a game. The very, very wealthy understand money and how it works and life insurance. Warren Buffett, okay, who was, is probably regarded as the greatest investor of all time. A huge segment / portion of his portfolio is life insurance. I talked about it in the first episode about the Rockefeller waterfall effect, where basically they buy a life insurance, and that's how this whole episode came up. I started talking about the Rockefeller waterfall effect, and their whole fortune is really based in life insurance that continues over and over. Each child that comes into that family, the Rockefeller family, puts an insurance policy on them. Now, we're talking about to a very small level in $100 per month compared to the Rockefellers that are probably putting in hundreds of thousands of dollars per month in premiums on people covered through life insurance through their investment portfolios. Okay. So, but at the end of the day, if you want to change, like I said at the top of the show, if you want to change your family's financial trajectory forever, you could do it with something as small as $100 per month. All right. Do me a favor. If you're watching this on replay, please share the episode in your network. All right. You see my email at the bottom of the screen, sme.dougstewart@gmail.com. If you are interested in setting up one of these policies, okay, email me, sme.dougstewart@gmail.com. Email me your phone number, and I will get back to you within 24 business hours. Or you can call me directly at 678-770-8073. That's 678-770-8073. One thing I got to mention this, okay? Another question that a lot of people have when talking about this concept, the $1 Million Baby concept, is why would I put it in a life insurance policy? Why would I put these premiums monthly in a life insurance policy when I can invest in a mutual fund or, just contribute more money to my IRA or whatever the case may be? Okay. The reason is because of the tax-free benefits that you get from life insurance. Okay. So there's 3 buckets, and I'm going to explain this real quick and I'm out of here. Oh man, only 22 minutes. Okay. In the industry, we talk about 3 buckets of how money is taxed. Okay. You have taxable, okay, investments, like bank savings, money markets and CDs, stocks, bonds, mutual funds. Then you also have the next bucket, which is tax deferred. Okay. And the taxable is obviously you're paying taxes on the money right then when you obtain them or when you put money into these accounts. Tax deferred, okay, when we talk about tax deferred, we're talking about the earnings of the money invested is not taxed until at a later time. Okay, y'all got that? Okay, so you have taxable now, you have tax deferred. Tax deferred items are like 401k, 403b, SEP accounts, simple IRAs, traditional IRAs, annuities, and real estate. You may not pay taxes now, but like when you sell that house and you made a ton of money on it, that's the gains. You have to pay taxes on that gains, whatever your tax rate is. So you're talking, if you're someone that makes a moderate income annually, you're talking 24 to 25%. If you're someone very wealthy in that top tax bracket, you're talking, as high as maybe 50%. Okay. And then the last bucket is tax-free. There you have Roth IRAs, which you're very limited in how much you can put into a Roth. I think like $6,500 per year. Then it's municipal bonds, okay, which don't make a lot of money because they're so safe. The more risk, the more reward. The more reward, the more risk. So municipal bonds, are tax-free, but you're really not going to get quote unquote rich or very, very wealthy from municipal bonds. They're safe. That's the good thing about it. You're guaranteed a rate of return, but they're super, super safe. And the last thing in the tax-free bucket is, you guessed it, life insurance. Okay? Now, there's ways that you have to go about the non-tax portion of life insurance, but it's, in effect, the monies that you've made in this tax accumulation life insurance are tax-free. One of only 2 or 3 different investments, as I just mentioned, municipal bonds and Roth IRAs, that you don't pay taxes on the gains. The money that you make, you don't pay taxes on it. So that's why it's super attractive for the very wealthy, okay? Because the very wealthy hate paying taxes, okay? That's why I told you, Warren Buffett, a huge portion of his portfolio, this guy's a billionaire. He's not too far behind Elon Musk. The reason why a huge portion of his portfolio is in life insurance is because of the whole tax benefit to it. All right. So once again, you see my email at the bottom, sme.dougstewart@gmail.com. You can call me direct at 678, grab a pencil, 678-770-8073. That's my phone number directly. If I don't answer, leave a message. Or shoot me a text, whatever you want to do. That's my personal line, 678-770-8073. If you want to change your family's trajectory forever, you be the catalyst to that, okay? Hit me up. We can get this policy signed and delivered and in underwriting in one day. Okay? So maybe we're not talking about your child. Maybe we're talking about your grandchild. And then if you're older, and obviously you will probably pass on the glory before your child, you transfer the policy to your child for their child, in effect, your grandkids, okay? sme.dougstewart@gmail.com, sme.dougstewart@gmail.com, or give me a call, 678-770-8073. And please do me a favor. This was only 27 minutes, very quick and precise, illustrations and everything. Share this video with everybody in your network, and I would appreciate it. All right? Y'all take care. Peace.